Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
You can't make this stuff up, Daniel. So we have this client. Well, actually, she's passed away at this point, but she was so concerned because of something that happened to her sister-in-law. And here's what happened. So her sister-in-law, we'll say her sister-in-law's parents are Mr. and Mrs. Smith. Mr. and Mrs. Smith. Now, Mr. Smith died. Mrs. Smith got remarried to Mr. Jones. Mrs. Smith died. Mr. Jones gets remarried to the new Mrs. Jones. Mr. Jones dies. When Mrs. Jones died, all the assets of the Smiths went to the kids of Mrs. Jones. And the Smith kids were disinherited of all that money that their parents had made and saved over the years. Those kids got nothing. So our client was concerned that that didn't happen to her kids and took measures to do this. But you can't make this stuff up.
Stranger than fiction. Yeah, this is an important topic that I don't think gets covered enough. And so we are going to be talking about, is it time for an estate checkup? I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Welcome back. If you're a regular listener, we're glad to have you. Excited about today's show, pumped up, ready to go. And, this is just really important to be able to take a look at, because first thing I want to say right off the top of bat, for over I'm in my fourth decade of encouraging people to get the proper paperwork together and get their estate paperwork together. And people say, I don't have any estate, I don't have anything. I don't have any, acres of land or whatever the case may be. But that's not true. According to the state, if you have a bank account when you die, you have an estate. So you need to make sure that it's working properly. And here's the first thing that people need to understand. Whatever time, money, and effort it takes you to take care of your estate plans is nothing compared to the time, money, and effort it will take for those who are left after you if you don't do that.
And people, not only is it less time, right? The amount of time it's so difficult for someone to try to get the funds everywhere they're supposed to go after the owner passes away. But a lot of times they don't know, if you don't have these documents together, they don't even know who you want it to go to or where it should be. Right. And then there's taxation consequences because of it. And it all becomes public, right? It's just, it's a big public mess. And the amount of time, like it could be years before it gets figured out. And if it ever gets figured out the proper way for the people who have passed away, who wanted that money most likely, or those assets, or whatever it is, jewelry, whatever it may be, to go to the proper places.
Right. And a great example of what I'm talking about is Prince, the singer Prince, died in 2016. His estate is just starting to get settled now. It was thought at that time that he had over $300 million of assets. Well, the IRS and the beneficiaries he died without a will, and so the attorneys have taken tens of millions of dollars every year for wrapping up this estate. Because what happens is, if you die without a will, you die intestate, and so then your estate is governed by the rules of the state, the statutory rules of the state, and it says who gets your money. But it's taken all this time to come to a settlement, and now his estate is valued at $156 million when it was thought it was worth $300 million 6 years ago. But of that $156 million, his beneficiaries are only going to get about 80 million of it, because the rest is going to go to estate taxes in Minnesota, I believe, is where he resided, as well as federal taxes. Crazy, right? Talk about the amount of money, time, and effort. 6 years, multiple millions of dollars being spent. Now, and people say, well, I don't have that kind of money, but take some zeros off the end. Right. It's still a lot of money and effort from that standpoint. Right. And, I'm thinking of, very a special client of ours that, at this point in time, the man has Alzheimer's, and the wife, she's not really involved, to much extent. And so the adult children are involved at this point in making sure that, they have the documents in place that they need to be able to finish out the life when the father, is expected, with his he doesn't have Alzheimer's, he has Parkinson's, but with his Parkinson's, with the ramifications having upon his mobility and so forth, and cognitive aspects that they need to get all these things in order, and it's kind of a pain for these adult children to have to go through this when it would have been so much easier. And I was after these clients years ago to get this thing taken care of, but now it's being a situation that somebody else has to take care of, when it should have been taken care of by them. Well, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is it time for an estate checkup? And we have something that we want to give you to be able to put this together, and it's the 10 mistakes that people make for estate planning. We love to give you this white paper. It is a paper to be able to read. It's only about 3 or 4 pages, and glad to give that to you by calling 800-725-7616. We'll send that out to you, 800-725-7616, be able to help you put together your plan and not make mistakes that others have made. Daniel, when we're looking at these things, and I've already said that, defined what an estate is, from the standpoint of everybody has an estate. And so many times people are busy, taking care of their money and building their estate and that kind of thing. They don't think about, what happens if I'm incapacitated? What happens if I die? And where does money go? And people tend to think simplistically, right? What's that thing that you were saying that you always see so many people saying?
Well, we see 2 things especially, right? One thing that we see all the time is people set up beneficiaries when they open, say, an IRA, right? So when you open up the IRA, you have to set up beneficiaries, and they set that up, and then it's 20 years later, and they haven't re-looked at who these beneficiaries are. It might be 30 years later. And people may have passed away. People may have been divorced. There's all these things, all these changes. They might have got married. We've seen all of these things. Now they're married, but maybe their brother is still on as the beneficiary instead of their wife.
Right.
Or their parents are on, and their parents have already passed away.
Right.
And so then
we see the opposite too, right? Where they get divorced, right? And their ex-spouse is still on as the beneficiary. And we've had a case where, right. And we've had a case where, we did a seminar talking about this, and the lady said, yeah, that was me. My husband died, my ex-husband died, and I was the beneficiary, and I love him for
it. So that's one thing that why we're doing this show, right? Do you need a checkup? Do you need to go do a beneficiary review? And different types of accounts have different types of titling to make sure you get the money to the proper people. And we should probably go at some point into those different types of accounts and how to get those things set up. But have you done a beneficiary checkup recently? You're always having life changes. So there's trusts that help people, that get the money, that get your assets, that get things that are important to you, to the people you want to get them to. There's wills, but then there's per account, there's specific ways that you can transfer money to the people you want, and skip probate, because like you were talking about, that's a big deal. That probate can go on for years and years and years. Everybody's got their hand in your pocket. And you said with Prince over the last 6 years and the assets are down. Well, what has all assets done over the last 6 years?
Growing
tremendously, right? Houses are up double. This is up, that's up. Right. So the estate should be bigger, but because no one's managing it, most likely because there's not someone set up. There wasn't a trust. There wasn't a will to say who should manage this.
Right.
So those are some of the things that we should probably dive into. But the other thing that we see that a lot of people do, they take a shortcut. Maybe they don't know. Maybe they're being lazy. I don't know what it is. But they'll say, well, I'm going to set Bobby up as my beneficiary, and then Bobby will give the granddaughters, money for college, and Bobby will divide it up. And there's there's all kinds of tax implications. Things could happen to Bobby. Bobby could die. Bobby could become, he could have a problem and not be able to make wise decisions or not be able to make any decisions. Bobby could decide he needs the money more than the granddaughters. People do weird things when money is involved.
That's right.
And you also just don't want to put that much responsibility on one person to make Bobby have to get the money to all the people he thinks you wanted the money to go to when nothing's in writing. Right.
It can be a disastrous situation. And things are not simple today. Things tend to be complicated, and because they've just expanded so much that it's not as simple as, well, so and so is going to get it. We've seen so many mistakes. I think of the mistake of how one of our clients came in, and his father, before he died, said, "Oh, I'm going to make sure my kids get this money properly," and then he put his stocks, the kids' names on his stocks. They were adult children, and so that caused a bigger problem than he could ever imagine, because what he didn't realize was that if he didn't have his name on the kids' stocks, when he died, the kids would have inherited him for the value that they were upon his death. But instead, the kids inherited them at a much lesser value, so that when he died and they sold them to put them in his names, they paid huge taxes on it. So it did just the opposite, because he didn't know what he didn't know, and he had just enough knowledge to make himself dangerous. And how many times do we see that, Daniel, in this line of work that we do? We got so many people that are doing it themselves. They don't know what they don't know. They don't do it. They retire once, hopefully, in their life, whereas we retire every day, right? Because we're retiring people every day. And so we see it every day. We can tell somebody who's 60 years old what's going to happen when they're 80 years old or whatever, because we see it. We've been through it. And that's why we're coming to you and our listening audience today, saying, hey, pay attention. Here's some stuff. You don't know what you don't know. Perhaps there's a lot of aspects behind this, and we're not attorneys, so we're not giving legal advice. We're just saying, hey, here's what we've seen, and please be cognizant of it so that you can make smart decisions instead of just decisions by mistake or by just because. Well, you're listening to Agemy, or you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is it time for estate checkup? And we have a book we'd like to put in your hands. It's called Three Blind Mice by our friend Scotty McLean in Wonderland down there. And so Scotty has written this book that talks about making sure that your estate plan is working together, your CPA, your accounting plan, as well as your financial plan, and making sure all your people are talking together to wrap it up into a nice package that will actually work for you and your heirs instead of against you. So we'd like to give you this book for free, and $25 or $30 book. We give it to you for free just for the asking. Call us at 800-725-7616. We'll be glad to get that out to you. And we're going to be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, we were just talking about, we want to help people to make a decision on purpose rather than making a decision by indecision. And I want to give an example. In 1955, the movie Rebel Without a Cause came out, starring James Dean. Unfortunately, later that year, at 24 years old, James Dean died in a car accident. And he's a great example of somebody who made a decision by indecision. He did not have a will when he died. And so because of that, what happened was his estate, he had a lot of money. His estate went to somebody he did not want it to go to, or you don't think he wanted to go to, because his father left when he was very young, and he was raised by his aunt and uncle. Well, when he died without an estate, he died intestate without a will. and the state decided that his father would receive all the James Dean's money. And so this man that had nothing to do with his life ended up with all the money because of it, decision by indecision. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is it time for an estate checkup? And Dad, you don't expect anything to happen when you to need an estate plan, to need a will when you're 24 years old. But that
Right.
just goes, it goes to show you never know what's going to happen. And so we talk to younger people all the time like that, and there's certain things they need in place in order to make sure that if something happened to them, their children get
Right.
the right guardians, right? The
Right.
children get the right guardian, that their things are being passed to who they want them to. And
Right.
there's so many important things in life, finances, estates, all these things where you're going to make a decision,
Right.
whether you do it or not, right?
Right.
It's just one way you consciously make the other decision, and the other one happens through osmosis, right? It just happens. Somebody either else makes it for you, or whatever will be,
Right.
will be, which is, we talk about with retirement plans. That's not a plan, right?
Right. Right.
Hope is not a retirement plan. Hope is a wonderful thing, and it's done great things for lots of people, especially for America. But that's not a retirement plan. You can't retire on hope, just like you can't hope that your estate will get passed on to all the proper people at the proper
Right.
times, and who you want to be blessed, the charities you care about will get that money because the state decides for you, or you give the money to Bobby and Bobby's going to divvy it up properly, right?
Yeah, right. And the bad thing, like you said earlier, is that unfortunately money divides siblings, and I've seen it unfortunately too many times, that when somebody dies and then the estate, is divided, and it drives wedges between brothers and sisters. I just the other day sat with a client who the father had two sisters and a brother. The father had taken the brother out of the will. The brother still thinks he's due money after the father died. And so, but the one sister doesn't want anything to do, doesn't want to give him any money. The other sister is a peacemaker, and she just wants to give her part of her piece of it to make him happy. And it just drives this wedge between people, unfortunately. And I'm just so blessed, so grateful, that when my mother died, when your grandparents died on your mother's side, none of that occurred. They all worked together, and it all worked out smoothly and nicely. And that's my desire, when I'm done in this life, and your mother's done in this life, Daniel, that everything goes in that same fashion. And so, it's important to us, and we've got those plans together. And when you're talking about and reviewing your plans, people don't understand that typically there's 4 documents minimal that need to be put together for people when they're doing their estate planning. And it's really interesting because one of these documents are for when you die, the other 3 are for when you're alive. And now you might have more documents than these 4, but these are the basic 4, right? So one is the last will and testament, saying how you want your estate divided up. Another one is the health care power of attorney, which says who can make decisions for you should you be comatose or whatnot. And then there's a living will that says whether or not to pull the plug while on the machines that might be keeping you alive. And then there's a power of attorney, which gives permission to other people, whether it's the spouse or it's the children, adult children, whatever, to be able to write checks or move money or take money, or required minimum distributions out of accounts or whatever it may be. So, 3 of those things are for while the person's still alive, and the one is for when they die. And then, of course, there's other things that people can have with that too. But those are the basic essentials, so to speak, of estate planning as far as documents go. And many times I'll talk to people, they got, a will from when the kids were young, 30, 40 years ago. And that's probably not, and typically they don't have the power of attorney. They don't have a living will. They don't have, this other stuff. So you need to get that stuff all, checked up on and make sure that you have everything in order from that standpoint. And, I see that, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is it time for an estate checkup? And we have a paper that we'd like to send to you, give to you, which is the mistakes that people make with estate planning. And this will give you a primer on how to be able to put together your estate in a way that you at least check off the boxes and make sure that you got some things taken care of with that. And you can have that by calling 800-725-7616, 800-725-7616. We'd be glad to get that out to you. Daniel, there's always trusts that are involved, right? And trust is something that, people hear the word, it's like annuities. People hear the word annuities and it could mean a lot of different things. And same thing with trust. Trust, can mean different things. You were telling me before the show started, you need to get a trust, some trust set up for in regard to your estate and whatnot. What do you have to say, to our audience in regard to trusts and where they come into play?
Well, trusts are a funny thing because there's a lot of seminars or there's a lot of attorneys that are pushing, buy this trust. And I mean, that's why we're giving that book away today, right? We're giving that Three Blind Mice book away today. Because how many times do we see somebody come in, they spend all this money on a trust, thousands and thousands of dollars on a trust, and the trust doesn't own any of their assets.
Right.
And it's like, you got
not going to do anything for them.
You got your house, you got these things, you got these businesses, but if it doesn't own it,
right,
then what do you got the trust for?
Right.
And there's ways you can work it, but like, typically when people spend all this money on this trust, the trust is supposed to own their assets. And then that way, when they pass away, there can be a executor or I'm drawing a blank.
Trustee.
A trustee who manages that
right
the way the trust says. And essentially you are controlling your assets from the grave, right? Because they're following all the things. You could get an income trust where you pay for your grandkids' education, or you pay for your grandkids' life, but you don't give them all the money,
right?
Because I mean, we know many, many people who got money when they were young and they didn't know what to do with it, and they blew it all, and now they say, "What? I wish I knew." Right? So you just set it up as an income trust, so they just collect the dividends and interest off the trust, right?
Yeah.
But making sure if you have that trust that it's set up properly. So your attorney has to speak with your financial person, has to talk with your tax person to make sure it's got the right tax return for the trust, and it's being followed properly, right? There's stipulations on what you need to own inside the investment accounts or whatever that is. But a lot of times people set these things up, like you were saying with the will as well. They set it up, and then it's 20 years later, they have way more assets. Their kids are growing up. This happened, that happened, and it doesn't fit their lifestyle. It doesn't fit their needs any longer.
Right. And so many times I'll be asked the question, do I need a trust, Andrew? And the answer is it depends. Because what kind of trust? There's different kinds of trust, right? So first of all, there's revocable trust that you can change it during your lifetime. And then there's irrevocable trust, where essentially you don't change it. You set it up and you let it run. Now, there are different trust breakers and protectors and things that you can implement to do different things. But basically, a trust allows you to handle your money in whatever fashion that you want. So there's revocable and irrevocable trust. And then there's trust. Typically when people go to these seminars for trust, they're talking about revocable living trusts, that where they put their assets in and it owns the assets and that kind of thing. But sometimes there's irrevocable trust that are important for estate planning purposes, because if you have life insurance in an irrevocable trust, then you don't own the life insurance, the trust does. So therefore, if it's $1 million life insurance policy, it's not $1 million in your estate that can be, if you're high enough, taxed and so forth by the state or federal government. It's outside your estate, so it's not taxed. So that's the reason to be able to do these things. There's there's qualified personal resident trusts that some people want to help them prepare and allow the house to be passed on to their kids if they need stuff, if they need long-term care or whatnot, from by a facility. There's special needs trust for children. Maybe they're adult children, and maybe they're on Medicare, Medicaid or something, getting assistance from the government. They can't own anything because it will go to the state or whatnot, the government. So that's what they use special needs trust for, because the trust owns the assets. We have a lot of clients with these. The trust owns the assets, and then the trustee is able to give money to that disabled or handicapped person as they need to for vacations or improve the quality of living. So there's a lot of different kinds of trust. The question, when people say to me, do I need a trust, Andrew? I'd say, well, what are you trying to do? What do you want to do? And sometimes the answer is yes, you need a trust. Sometimes the answer is no, you don't need a trust. There's trust, there's grandchildren's trust. One of the things that I'm trying to put together for my grandkids right now, to make sure that the money is going to be able to be used, and that as it grows, that they don't get it when they're 18 years old, that they get pieces of it and that kind of thing, right? So all these different assets, all these different trusts that are available and things that can be done. Well, I'm talking a lot, Daniel. I'm sorry, but I see that it's time for us to take another break. And I'd like to tell you in our listening audience that you're listening to Agemy, to Financial Strategies with Andrew Agemy, and we're glad to have you on with us. Hope you're getting a lot out of this. This is going to be available in a podcast, along with our other shows are available any place that you listen to podcasts, or on our website, agemy.com, agemy.com. And this is going to be a good one, Daniel, that we're going to be able to use to send out to people when they ask the question, do I need a trust, right? We'll be able to send this to them, have them here, listen to what Andrew and Daniel say about that. But anyway, we've given away this book, Three Blind Mice by Scotty McLean, that will be able to help you to be able to make sure that your financial person, your investment person, your accountant, and your attorney are working together to put together a plan that works for you, that's customized to you. And you can have that for free by calling 800-725-7616, 800-725-7616, or you can also go to our website, agemy.com, and send us a comment from there as well. And we'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's agemy.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, I started the show today by saying, you just can't make this stuff up. So here's another one, right? All right. So we got four brothers. The father had $1 million IRA. The father dies. Now, under the laws that were in place at the time, if he made the sons each beneficiary on that IRA, each son would end up with $250,000, and they could have just taken out a minimum distribution every year on that because they didn't want to pay tax on $250,000. That would have been a beautiful thing. But unfortunately, in this case, the father made a trust the beneficiary of the $1 million life insurance. So what happened, the $1 million IRA. So what happened was, when the father died, the trust is the beneficiary. So in order to get to the trust, taxes were paid on that $1 million. So what ends up in the trust? About $600,000 after tax.
Ouch.
Now, Ouch is right. Right now, each kid, instead of getting $250,000 that's going to grow for their future, gets whatever, $150,000. And guess what they did with it? What
Spent
most
it.
beneficiaries do when they get inheritance, a cash inheritance. What, Daniel?
They spent it.
They spent it. Exactly. And so, that could have all been changed if it was that if the father made sure that his estate was working the way he wanted to work, because I'm sure that's not what he intended for it to do. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about, is it time for an estate checkup? And is it time to get a second opinion on if you do have a estate put together, beneficiary second opinion, because you don't want some of those things to happen. We talked about we need like a hall of shame for some of all this stuff, all these things we found, and hopefully a lot of the ones that you're not telling are ones that you help people fix before they had these problems. But yeah, the proper ownership, the proper beneficiaries, and maybe we should spend some time right now going into the right times to use the trust, the right times to use a TOD, the right times to use a beneficiary. Because if you have a trust, then you're like, well, I have this trust, I think I should have a beneficiary on everything. But different types of assets, you may not want it to, because non-qualified monies may transfer better if it goes to an individual, or a beneficiary definitely transfers better because they have more exemptions, they have more options. They could still take all the money, right? If that father set their kids up as beneficiaries on the $1 million IRA, they could still cash out that $250,000 and go buy a house, go spend it, do whatever they wanted. But if they didn't want to, they said, hey, I don't need to do this. I want to save this so that I could give it to my kids, or I could use it in retirement or whatever. They'd have that option as well. And they could just use the income it's generating to pay the RMD each year and not have to pay all that taxes.
Right. And that's exactly right. When we're talking, making sure that that the trust is used properly, making sure that the beneficiaries are proper, right? Because there's, if you have an account that has beneficiaries like life insurance or annuities or IRAs, 401ks, then that money is going to go right to the beneficiary from that standpoint. And it's not going to go through probate. Now, it may be counted in probate, depending what's happening, but it goes right to the beneficiary. So that's a thing that people need to understand. And when some accounts don't allow for beneficiaries, but they allow a transfer on death or paid on death, TOD or POD. And so, many times at the bank, you can get a POD. So what that means is that, if you put your kids on as the POD, TOD, then they get the money, they're transferred. If you die, it works just like a beneficial arrangement. Very good way of doing things from that standpoint. One of the mistakes I see people making, Daniel, is, I'm going to put my son on my checking account. It's got $100,000 in it, $40,000 in it, whatever. I'm going to put my son or my daughter on as a co-owner of this. That way, if anything happens to me, they can still write checks and such. Well, the problem with putting on, one of your adult children on your assets as an owner is the fact that bad things happen to good people. So, we live in a society today that your son or daughter could be in a car accident, not be their fault, but they could still be sued for it. And when they're sued, what are their assets? Well, their assets, if their name is on your house, your account, that's their assets. So that becomes part of the settlement. So, or let's say your son and daughter get divorced and it's in their name. Well, guess what? Now, if it's your son, the ex-wife can end up with your house or part of your assets because of that. You have to take out a mortgage to pay the ex-wife. So that's not necessarily the best way to address, your assets. There are different things that can be done, which could make a lot of sense from that standpoint. So this is an important thing to understand. What are your thoughts along those lines, Daniel? You're a man that has a lot of thoughts. Oh, I'm going to ask you that in a minute, Daniel. I see that I need to offer this to people. So you're listening to Financial Strategies with Andrew and Daniel Agemy, and today's topic is it time for an estate checkup? And in order to help you with that, we have a video book on estate planning that we'd love to send to you. It's a 5.5 minute, 6 minute video to whiteboard video that I think animated video I think you enjoy. We'd love to send that to you via email. Call us at 800-725-7616. Ask for the estate planning video. Okay, 800-725-7616. Daniel, what do you have to say about this setting this money up properly for people, or whatever? What's your take?
Well, I think back to one of your earlier stories where the father thought he was doing a good thing, and he put the assets in the name of the children so that it would pass on to the children. But then the assets grew, and they grew and they grew, because this was years later, and they grew and they grew. And then the father passed away, and now the child inherited the money. Well, who was an adult now, he wasn't a child, inherited the money and had this huge tax burden. Whereas these TODs, transfer on deaths, are fairly new, but you put that on an account that typically doesn't have beneficiaries. And if that had been set up that way in that situation, the adult child now would have received the money at cost basis at the father's death. And there basically would have been no taxes to pay.
Right.
And the money skipped probate.
Mm-hmm.
And a lot of people don't set these up.
Right.
Either the bank doesn't tell them they can, the financial person doesn't tell them they can. It's work, right? It's an extra form. And then you have to verify who they want. And then a lot of times people will just put a primary. And that's great. But what if you're with your primary beneficiary and you both have an accident at the same time?
Right.
Or what just happens if you get busy doing life and something happens to your primary, and then something happens to you later and you didn't update it. So check these things out. These things out. Do you have TODs on your non-qualified accounts, right? You mentioned annuities. Annuities and life insurance have beneficiaries checked up. So do you have a primary and do you have contingents?
Right.
On the non-qualified stuff, is it owned by a trust so that it will live basically forever? Or do you have these TODs on the accounts? And then same with your qualified money, your 401k, your IRAs. These are things you need to check. Do you have beneficiaries, the person that you want, and then do you have contingents?
Right. And the other thing you saying earlier about the TODs and so forth, the other factor that comes in was the accounting nightmare for these children. It was exactly that, an accounting nightmare. And we are still, the father died in like 2010 or something, and our client is still trying to figure out what his cost basis is because of it.
They didn't have computers back then when those things were bought to track that.
That's right. I mean, it wasn't until like 2011, 2012 that these companies had to keep track of that stuff. So it still is crazy, right? So, and then a lot of these things were purchased even before then. But again, you can't make this stuff up, right? And that again, going back to the time, money, and effort that's involved with these adult children today is tremendously more effort and money than what if the father had done it properly to start with. What is it? Now it's all good. I mean, okay, let me just say this.
We always say, right? You never have time to do it right the first time. You never have time to do it right the first time, but you always have time to do it again and again.
Right. But to the father's, he thought he was doing the right thing. He had just enough information. He didn't know what he didn't know. And so he he didn't seek out people that did know the right thing. And I don't want to make this sound because, maybe the client's hearing this and he's thinking I'm bad mouthing his dad, but I'm not, But, and as the client would say, it's all good because I have more money than I would have had. And it's a gift from my father. Yes. The thing that is egregious to me is that the government is ending up with so much more than what they're due. if it was done differently. And, if you're in our audience today and you're, liberal, think of all those conservative things the government is doing with that money that they're getting. And if you're conservative, think of all those liberal things the government is doing with that money. Okay. So the point is, the government, they need money. They want as much as they can get, but we don't have to give them more than what is our fair share. And, so that's what we're trying to bring across here.
And Dad, you have taught me, right? Get experience as cheap as you can. Get learning as cheap as you can. And that has to do with some things you have to learn the hard way, but the more you can learn from other people learning the hard way, the better it is. And so if what our goal is today is not to say anything bad about anybody that set these things up that may not have worked out, the better. It's to give education so the people listening can learn from these things we've seen, because we've seen tons of people in tons of situations. They can learn from that, and they can go get a second opinion on the strategy that they have. Or if they don't have a strategy, they can go get a strategy set up, or they know the things to ask. Well, this happened to me. And that's what this is all about, is giving out that information so people can learn. They can get experience without having to have that that problem or that bad outcome themselves.
Right. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And today we're talking about, is it time for an estate checkup? And we'd love to put in your hand the book, Three Blind Mice, which will give you insight into how to put together a plan, will help you to know that what you don't know, so that you can at least ask the right questions, and certainly not make a decision by indecision. Make a decision on purpose. And you can have that by calling 800-725-7616 or checking out our website at Agemy, AGEMY.com. And we'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to Agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Dad, I've got a big family. Got some brothers, got some sisters, right? 5 brothers, 2 sisters. And as I go through beneficiary designation and these kinds of things, and I say, we talk to people all the time that have these questions, but I'm using myself as an example. And I say, well, I want to give, if something happened to me, my brothers and sisters, divide it up, give them all something, let them all benefit from me passing, right?
Right. What about your father and mother? Come on now. No.
You guys are doing fine. And then the thought comes, well, what if something happened to one of them? Would I want the money to go to just divide it up equally between all the other brothers and sisters? Or would I want it to go to their children, my nieces and nephews? And this is something that comes up all the time. How do you set that up? How do you designate that when you set up the account? I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is it time for an estate checkup? And Daniel, that's a perfect example of what I'm always talking about, is how important it is to understand definitions of words and situations, right? So the words that determine how you want to do that is per capita versus per stirpes. So per stirpes means in the bloodline. So
this is
that's
when you're filling out those contingent beneficiaries, and you see these weird words that you're like, what does that mean? Right. But sometimes they're not even on those documents, and you have to go back to the company and find out, well, which is mine, per stirpes or per capita? Because some
the per stirpe things goes through the bloodline, where per capita is whoever the beneficiaries are. So, quick, easy illustration: we have Mary and we have Pete. Pete has a son, and they're both, Mary and Pete are the beneficiaries on their parents' life insurance account. Well, if it's per capita and Pete dies, Mary gets 100% of the assets because it's only her. If it's per stirpes and Pete dies, well, Mary gets 50%, and the grandchild, Pete's child, gets the other 50% because it's per stirpes down the bloodline is the idea from that standpoint. Now, a lot of people listening to us have no clue what we're talking about. But that's why we're saying this, is because, upon death, that makes a difference, because I'll talk to people and they'll say, well, I want my grandchild to get it or whatever. And so that needs to be part of the analysis when you're doing a beneficiary review, you're doing an estate checkup. You want to make sure you're looking at these angles and understanding, again, those words are per capita versus per stirpes. And the easiest way is per stirpes is down the bloodline, where for the children or grandchildren, whatever the case may be, multiple generations, as opposed to per capita is per however many people there are as the both beneficiaries. It's just those beneficiaries. So that's a key thing to look at. And
yeah, we suggest people get, check these things out at least every 5 years, right? Mm-hmm. And if they have big life events, then it needs to be sooner than that. But right. But stuff changes, and your ideals change. The possibly the way you want to give your money to different causes or things like that, right. Or laws change, so it may change how you have these things set up, and that's a very important thing to know.
Right. And I'm thinking of a client I was just doing a review with the other day, and we set up her beneficiary. It seems like it's only been four years ago, something like that. And she says, I want to do beneficiary review, Andrew. All my friends around me are dying, and I want to make sure that my money's going where do I want to go. She doesn't have any children. It's all going to various organizations and so forth, but she wants to make sure she's given the right amount, the right percentages and such. So we're doing a beneficiary review for her. We're going to send that to her so that she can have it in writing and recognize who it is. And if there's any changes, we'll make those changes. But this is important. But when I want to talk about probate and how probate works, because a lot of people don't understand that. But, just before I do, I want to let you know, if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is it time for an estate checkup? And to be able to help you do an estate checkup, we have a video book of a nice animated video, about 6 minutes long. We love to send you on estate planning. And you can have that by calling 800-725-7616, 800-725-7616. Now, probate is something that when you die, you have an estate. If you have a bank account, you have an estate. What probate does is it takes your estate and makes sure everybody who, any debts that you have are paid, and everybody, all the money is dispersed in the way that it's supposed to be dispersed, and wraps up your estate in a nice tidy bow, so to speak. And then when you're clear of probate, it's all taken care of from that standpoint as far as the estate goes. Well, the question is, do you want to go through probate or do you not want to go through probate? And it depends upon different things. One of the reasons to not to go through, whenever you go through probate, is public knowledge to people. So whatever your assets are and so forth and so on, whatever goes through is known. And then probate charges a fee on how much assets go through probate. So the fewer assets that go through probate, generally speaking, in most states, the lesser money that you're going to be paying probate court. Now, the other aspect behind it is probate can take a long time. Now, for the general person who has, maybe just a house and some IRAs, life insurance, it may not take very long. But for people who have multi-million dollars, a lot of complicated estate, it could take years. Like we said earlier in the show, Prince's estate has taken over 6 years at this point, and it still isn't finally dispersed, but at least there's a settlement on it. So probate is something to be aware of. And that's one of the reasons why people get involved with especially living trusts, because if you're in a living trust, it keeps you outside probate, thereby keeping your information private, thereby lowering your fees, generally speaking, in most states for probate, and thus also allowing you to disperse the money in whatever reason, however you want to do, and control your money from the grave. Well, the difficulty with this situation is, especially when you talk about the state of Connecticut, because the state of Connecticut is my understanding, is the most expensive state to die in. Why is that? Because everything, even if it's in a living trust, is counted for probate purposes. Everything. So it's just a small percentage, but it's on a big dollar amount. So you're going to pay a lot of money in the state of Connecticut to probate. So for some people who have small estates, maybe they have, a house worth maybe $400,000, $500,000. Maybe they have an IRA worth $500,000, and you have one of these, these attorneys that say, "Oh, you need a trust, you need a living trust. It's going to cost $3,000 to get this living trust, and it's going to be complicated to do that." It may not be worth it for you to do that, because you're still going to pay the probate fees. You're going to pay the probate fees. You're going to pay the estate, the trust fees. You're going to have to do all that work to get the assets in the trust. But for people who have multi-million dollars, well, it could be very well worth it for you to have that living trust from that standpoint, to be able to take care of that and to make your assets private from that standpoint. So you need to understand, as in everything, you need to understand the words, the definitions, the terminology. And at Agemy Financial Strategies, we're glad to be able to help you understand these things. And that's why we have this show, Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We want to help you to be able to make the right decision by decision and on purpose, rather than by indecision. We want to give you the knowledge that you need to be able to do that. Daniel, we need to be wrapping up here. There's so much to take in with this stuff. What perspective do you have as we are getting ready to wrap up for today?
I think we should wrap up some things, some takeaways people should write down, put to memory, so that they can have a plan of action to move forward from this, because we covered a lot of different things. And the first things that I would like people to remember is check the ownership of your accounts. We talked about this. If you have trusts and the trusts are supposed to own certain assets or certain accounts, it doesn't do you any good to have that trust if the things it's supposed to own are not owned by it.
Yeah,
So
if it's not funded properly. All right.
Check the ownerships. Check your beneficiaries. Do you have the proper people on the proper accounts, right? And the proper types of people and types of accounts. So if you want money to go to charities when you die, is your taxable money going to the charities, because they won't pay tax on that?
Mm-hmm.
And is your stuff that your children, whoever can receive at cost basis, going to them instead of the reverse?
Right.
So check the beneficiaries. Do you have the right people? Are the right types of accounts being passed to the right types of entities? Do you have contingents? And on your non-qualified stuff, do you have beneficiaries on it at all?
Right.
Get those things set up properly, because this can save a lot of headache, a lot of money, and it ensures that you will be blessed and you will be taking care of the proper entities, and someone else making the decision for you, guessing what you may want, or not even guessing, just deciding if it goes to probate, just deciding who should get these things.
Right. Good. And what I would like to, for you and our listening audience, is several things. We're asking, is it time for an estate checkup? And maybe you have attorneys. And people say to me, "Oh, I have an attorney. They did the closing on our house." Well, that doesn't mean they're a estate planning attorney or a tax attorney. That doesn't mean they're a specialist in what you need. They can have a boilerplate. So just be careful who you're talking to. If you need help with that, we have an associate. We're involved with an association that connects us with attorneys throughout the nation. We can help you with the bigger picture of things and guide you through that if you want us to. We're not pushing it. just let us know if you call for the book or the video book, whatever. Also, that's, why we also have Connecticut Sound Tax Group, is because we also do tax planning and tax preparation for people in and close to retirement, so they can get a quality tax return at a reasonable rate and get some tax planning with it, because, it's not about what you make that counts, about what you get to keep that counts. So, if you need some help, want some help, we're glad to help you and coordinate this. But we have this book for you today called Three Blind Mice. We'd like to put that in your hands and for free by calling 800-725-7616. Love to hear your take on that. And if you're so inclined, but we'll send you that book. Let us know, 800-725-7616. If you want some help, let us know that as well. And we'll be looking forward to you too can have a stress-free retirement. This stuff sounds very, awesome and just very big and encompassing, but that's what Agemy Financial Strategy is about, trying to help people to be able to take the stress out and make it simple. So until next time, you too can have a stress-free retirement.